Good morning. This is our last lecture. And after this lecture, there will be a test next week. It will be online for 3 hours in Connect. And it will cover all the material. It will not just be on what I talk about today. For completeness, I'm going to discuss this topic. If you guys have questions about the other material I gave you, please let me know. I can do office hours. I haven't done office hours at all this semester. You guys seem to be working well independently. As far as the Connect exercises go, the ones I've posted so far, I will be dropping the worst score. So some students didn't do some of them, so I will just drop that assignment. And others who've done all of them could skip this assignment, but I don't recommend it. I think you should try everything. I'll just drop the lowest grade, right? So you'll only have grades for 3 because there were 4 assignments. Is that correct? So I just sent you those notes. Yeah, just 4 assignments. I was verifying. Ariana, you need to work on materials. You have lots of materials. You have summary pages of materials. The best thing to do is just review that you understand where you went wrong in solving problems. The test should be fairly basic, but what I want you to get away with is a nice review of your materials. So go through it and let me know if there's anything outstanding that still confuses you, and I can look at it at some point next week. I can come on and do office hours, just answering questions. Okay? So let me write it in the chat that only 3 of the 4 Connect exercises, Connect assignments to review the final exam. You should look through all the problem sets and solutions you have been given so far. So this new material will be a small part of the exam. They'll help you with your last assignment. So I suggest you do the last assignment, even if you don't do it well. Just do it. Do it the best you can. I shouldn't say not to try. It's good to review. What we're going to talk about today, if you don't have any questions for me, is capital structure. That's the right mix, or the mix of debt and equity of firm issues. Okay, I guess we're almost at 15 minutes, so I guess I'll just start, even though it's 9 students. So no questions from me? So if you have any outstanding questions about the materials you have, email me and I'll do a review. Right now I'm in the process, we are in the process of hiring a new professor, and I'm going to be really busy with that this weekend. But after Monday, I will be at your disposal. I will be available to answer questions or make videos or meet with you through Teams or even in person, if that helps. I'm not even sure if, you guys are tired of Teams. So let me know what works for you if you need some help. It's hard to do a review because you have all the videos to review, so review those. You have lots of things to review. What it is identifying where you have confusion and letting me know so I can resolve the confusion. Most of what we did the last while with the WAC, you should have seen that in 3106. What I do is just go a little deeper with that. And I trust you'll let me know if you have questions. All right, so what we're going to talk about today is what is the optimal capital structure for the firm. So first, let's remember that the value of the firm, the value of its assets is equivalent to what it owes. What it owes its creditors in debt and what it owes its shareholders. So you can imagine, you can visualize if you've seen this before, the value of the firm as a pie, and the partitions of debt and equity making up that pie. Now, the question is, shareholders as the owners of the firm, what is their goal? Should they be concerned with their wealth, or is that distinct from the value of the firm? So we're going to talk about that, and I'm going to refer to some models that were developed to help tease apart the relevant issues and tackle that question. And then we're going to look at the theory around maximizing shareholder equity, because it's going to be determined that shareholders are concerned with the value of the firm overall. And then, what is the optimal capital structure? What is the optimal mix of debt and equity? Or we can write that as the debt to equity ratio. So there is a tension between bondholders and shareholders that I've described before, because shareholders are residual claimants to the profits of the firm, right? After all, like the bondholders, right? Creditors are paid first. They have a claim on their interest payments, as determined in the bond agreement. So we're going to start with the first question. Okay, we have 10 people. I'm going to go ahead. That's about right. So we're going to start with the first question. And sorry, I gotta go down here. You have your slides. Okay, so what we have here is it's just an example, okay? We begin with a unlevered firm, so a firm that doesn't issue debt. And let's say it's determined that the value of the firm is $1,000. That's the value at the same time of the outstanding stock, you see? Because there's no B, it's just V equals S. B is 0. There are 100 shares outstanding, so that makes each share worth $10. So what happens if the firm decides it wants to consider issuing debt? So let's say they do that. They issue debt in the amount of $500. And they turn around and redistribute as a dividend to the outstanding, to the shareholders. So a dividend to each share would be $500. So in a way, taking on debt and then paying off shareholders as a incentive. Let's say this was the decision. What would happen? So I present 3 scenarios: the best, the same, or the worst. And in the 3 scenarios, how do shareholders perceive the outcome? So in all the scenarios, the debt issue is $500. What happens to the value? What happens to shareholders from the shareholder's perspective? What happens to their value, the value of their outstanding shares? Let's say that the market considers that a good thing, and the share value of stock outstanding was $750, where that represents as a residual claimant, that means that the value of the firm would be $1,250. So that's the best case scenario, that it increases the value of the firm. If nothing changes, then to retain the $1,000 value of the firm, that means that shareholders as residual claimants would have the value of their shares drop to $500, but the value of the firm remains the same. You with me so far? In the worst case scenario, the value of outstanding stock falls to $250. In this case, the value of the firm has fallen to $750. So the best, so we're really looking here, best, same, and worst. So this is the impact on shareholder equity. This is the impact on the value of the firm. But don't forget, there's a payoff to shareholders for the restructuring. Let's consider together the capital gains effect. Here, the capital gains effect is minus $250, right? They went from $1,000 shares overall, stock outstanding shareholder equity, to 750. So that's a loss. That's capital gains of 250 negative. So that's a loss. And then here it's 500 negative, right? And here it's the worst, negative 750. Now you have to offset that as with the payoff for the restructuring. Those 500 in any case. The net effect are here. So I made a bunch of calculations. How do you conclude? What do you see here? U for unlevered. U for unlevered. So this is the firm. So this is the firm with no debt. And so the company looks at restructuring, and there's three possible effects: bad, no effect, and the worst case scenario. And I demonstrate that when the value of the firm goes up, so does the shareholders' payoff. When the value doesn't change, neither does shareholders' payout. And when the value of the firm drops, so does shareholder payoff. So shareholders should be concerned with the firm's value. It affects them. Okay, you want me to do this again? That's the main conclusion. I don't know what's going to happen. I don't know if this is going to happen, that or that, but shareholders do care about the firm value, and they are interested to increase value, to increase shareholder wealth or payout. They want to increase the value of the firm, so they are concerned with capital structure. So U for unlevered. Ready? So that's my argument for shareholders caring about the value of the firm and maximizing V as a way of maximizing S. The next question is, you might not get it right away, but rewatch the video and the explanation and it might help. Now the question is there an optimal capital structure? Is there a pattern, or is this really random? Is there a pattern to knowing how to determine the ideal amount of debt to issue? And we turn to the theory of Modigliani and Miller for some answers. And what they set up in their seminal work, we're going back to the 50s, is that if you take away, or you create a number of assumptions, so you take away reality, okay? So we remove a lot of reality and create a set of assumptions. I can show you what they say about where capital structure doesn't matter. So capital structure will not matter. So in this case, the levered, that's the firm with debt, and the unlevered without debt. So same thing over here, right? L is levered with debt. Let me make the terms clear. So when would this be the case? When won't it matter? Doesn't matter if you have debt. Well, if there's no risk of default, so there's no risk that creditors won't get paid and turn around then and sue for their claim on to their interest payments, okay, which creates problems for shareholders, and because the value, the perceived value of stock will drop in the markets. Okay, so if we remove that risk and we assume cash flows are perpetual, so we're assuming that the firm exists forever, which we've been doing in valuation. It's a strong assumption, but it's the one that we use. And we also assume another strong assumption: firms and investors can borrow and lend at the same rate, which is not necessarily the case, right? And this is the strongest of all, and I put it in bold here. There are no taxes. How does this affect things? What's the deal with taxes? Well, it's because of taxes and the tax deductibility of interest payments from the perspective of the firm that makes debt attractive. Okay, so I'm going to remove that incentive for debt, and with these four assumptions, we will find that it doesn't matter. So now I got to show you how that could be the case. So this is known as Modigliani-Miller M&M Proposition 1. Proposition 1 looks at the firm value. Proposition 2 will look at the effect on the cost of capital, okay? So with no taxes, consider these two firms. One with no debt, so the value of the firm is equivalent to shareholder equity, value of outstanding stock. And we say that they're identical, these firms are identical, this one and this one, in every other way except one is levered and one is not. So my question here is, with debt of $400,000 issued, none in the unlevered firm, and the cost of debt is 5%, keeping all those assumptions in tow, right? So the firms and investors can borrow and lend at the same rate, and there are no taxes. I'm going to demonstrate to you that the value of the firms, the value of the firm, V, is the same. So I begin with this because we've assumed that everything is the same. We're going to also assume that the dollar return on the firm's assets is the same. So that's going to be called Y. So that's some amount. Dollar return on firm's assets. All right, so next, I make a table. And what I'm going to argue here is in the end, I'm going to be saying that the firm values are the same. Now this is how I'm going to do it. This is how I'm going to show that. Consider an investor in the firm with debt, the levered firm. That investor buys 10% of the value of outstanding stock. So that would be 10% of outstanding stock, right? And then, so this is, you're going to see this calculation a lot. This is always because V equals S plus B. So that means the dollar investment is 10% of the value of the firm less the outstanding debt. So this is the dollar investment. Everybody okay so far? So what's the dollar return? Well, I said Y would be the dollar return for each of the firms. So this is the levered. But then bondholders have to be paid for every dollar invested, for every dollar of outstanding debt. Interest payments, right, are made. So this represents the interest paid to debt holders. So that reduces the returns. What did I call it? I called it assets, right? Dollar return on the firm's assets. So this is the dollar return less the payment to bondholders. So then I put the numbers in. So you can see that $2,000 will be paid to bondholders. Not 2,000, sorry. It's not going to be 2,000. It's going to be 20,000. Let me make a note here. This will be 20,000. But then this has to be 10%, right? Is the dollar return to strategy A. So 10% of the dollar return and 10% of the payout to bondholders. So, okay, so what we have here is the dollar investment and the dollar return. Everything okay so far? So strategy B, this is a different approach. Imagine an investor buying 10% of the unlevered firm now. So 10% of the unlevered firm basically is 10% of the outstanding stock. Sound familiar? But then by borrowing 10% of the value of the debt in the levered firm, so I'm just talking about the value, not necessarily borrowing that debt, but borrowing, right? Because we assumed that firms and investors can borrow and lend at the same rate, and there are no taxes. So they can borrow 10% of this value, and that would have to be That would be a negative, right? Because that has to be paid back. So if I put that together, I get this. So this is now, this is the investment. In strategy A, this is the investment in strategy B that focuses on investing in the unlevered firm. What would be the dollar return? It would be 10% of the dollar return to the firm, less what has to be paid back. And when you put that together, it looks identical to the dollar return for strategy A. So what's happened here? The dollar returns are the same, it turns out that the initial cost of both strategies must be identical. So we always assume in these models that we have efficient markets. And in efficient markets, there should be no arbitrage opportunities. Like when we talked about adjustment to the security market line, right? We assumed efficient markets, all investors have all the information, and there are no arbitrage opportunities. We always talk about fair price. Well, in that same spirit, the initial cost of both strategies must be identical. If these are identical, then you can see algebraically the value of the firms must be identical. So what's happened? An investor in the levered firm could be created, like we talked about again with the SML. I could create the same portfolio in the SML by combining the market portfolio with the risk-free T-bills, either borrowing or lending T-bills. Similar here. This is borrowing on your own account, investing in the unlevered firm with no debt, but then you can create the debt yourself because, well, with the strong assumptions, it turns out that with these strong assumptions that the firms have identical value. So no matter the leverage taken on, the firms will have the same value. Okay, so debt doesn't matter here. So I've removed all the risks. Going back to the assumptions, it's all in here. So I made it happen. All right, I made it happen. There's no risk of default, so we're not scared. As shareholders are not concerned about default risk. The firm's going to exist forever. Cash flows are perpetual. It means it's going to be the same forever. And there's the same rate for borrowing and lending and no taxes. So taking away the incentives and the risks of debt, you'll find they're the same. So once I start to remove these assumptions, you'll see there's a change here. Okay? So that's what we're interested in. But I needed to state first the case where you'll find the values of the firm are identical. And you need those assumptions to make it happen. So in the first proposition, we see this is the visual diagram that we're going to use. And this is the basic example where there's no difference. Okay, so this is like your baseline. And don't forget, there's no corporate taxes, but there's other assumptions as well. So no matter what the debt to equity ratio, the values of the firms are identical. So what we're going to do is remove some of those assumptions and see what happens. Oh, first I have to give you the baseline for Proposition 2. Okay, so Proposition 2 is still, we're with the same set of assumptions. What happens to the WACC? So let's look at the cost of capital. The weighted average cost of capital measures that. Remember, there's no taxes, so I don't have that extra 1 minus TC here. I'll put it in just in case. So if I had 1 minus TC, this would be 0. So we use the symbol RU for the unlevered firm. And this is the return to investors in the unlevered firm, which would be the WACC, because because they're, let me see, that's the levered firm. Since the value is the same, so what is done here is that this would be, the WACC would represent the return to investors in the levered firm, right? Because that would have both equity and debt. And this is the WACC with that equal to 0, with the taxes equal to 0. And this return would be constant on firm's assets. We have in the levered firm shareholders and bondholders, however, and let's see, how does this affect the return to shareholders in the levered firm? So you can rearrange this algebraically. Do you want me to do it? This will be you know what, I'm going to do it on another page. Let's do it on another page. So I want to solve for isolate RS. I don't know if I'm doing this the long way. I'm going to do it the long way. Are you with me still? And I want to solve for RS. And you see what's going to happen here? If I take RS and I move this to the other side, do you see what's next? Where are we headed? We're headed to this, right? So let me copy that so you can see it's... I'm not inventing this. It's strange. So then if you see if I divide by S, I'll get RU and then B over S in front of RU minus RB. Okay? So what does it mean? Could someone explain it? So what we have here is the debt equity ratio. So this is the shareholder. This is the shareholder in the levered firm. And this is their perspective that's captured in their required rate of return. That's what this is. This is the required rate of return of shareholders in the levered firm. This is the debt to equity ratio. No comments? What happens as the debt equity ratio increases? So what we have here is proposition 2. This has to do with the cost of capital and the effect on the cost of capital. So what, with all the assumptions we've made, I plotted the debt to equity ratio on this axis. And I've shown that, first of all, this is the return to debt. It doesn't change, right? There's no risk of default. Remember, this is because there's no risk of default. Let me make this bigger. So bondholders or prospective bondholders aren't worried about default risk. The firm's going to exist forever with perpetual cash flows. So there's no additional required, they don't require a higher rate of return to compensate for that additional risk. So this is going to be flat. The return to investors in the levered firm is going to be the same as the return to investors in the unlevered firm, where we call the return to investors in the levered firm the WACC. Okay, so this is WACC. And those will be no different. Right? The return per dollar invested shouldn't be different for investor in either of the firms because the values of the firms are the same. But then I asked, so how do we maintain, what do we see from the shareholder's perspective in the unlevered firm? And you get this equation. And this equation will always be positive, right? For as the return to investor in the unlevered firm is this one. So this is flat. So this one doesn't change and this one doesn't change. But if debt to equity goes up, the return to shareholders in the unlevered firm increases. So shareholders in the unlevered firm, in the levered firm will demand a higher rate of return for taking on more debt. So these are the different players. These are the average investors in the levered firm, but this is just the shareholder in the levered firm. Exactly. So this is the result of leverage, right? Or taking on debt. So this is there are a lot of assumptions here. And these are the results of making those assumptions. So again, bondholders have a steady required rate of return. Investors in the levered firm have a steady, stable required rate of return. But shareholders in the levered firm, as a result of leverage, they require a higher rate of return for more debt. And this is a result of all the assumptions we made and the fact that the values of the firm are identical. So bear with me, that's just the base case. Okay, now I'm gonna vary a few things and we're gonna see the impact. back here. I think that was the last slide. And then here. So now what happens? If I add taxes, okay? So I'm going to include taxes now. But I'm going to continue to assume that cash flows are perpetual. There's no depreciation. This is just added on because I said something about taxes. So trying to keep it simple. And and I've also, to keep it simple, so this doesn't become a huge capital budgeting exercise or case, there's no fixed asset or no net working capital spending, so that you don't have to do anything with investment. So we don't have to include anything like we would in capital budgeting for investments. All right, so I'm adding taxes. So what happens if you add taxes back? So I put some numbers here, hopefully to make it easier to understand. So a firm that is currently unlevered, so no debt, just equity, is considering going from zero debt to $400 at 10%. So I make up this number. I say these are earnings before interest and taxes, okay? And I'm going to make, that's another assumption. Remember, we said cash flows are perpetual. So in any year, we're going to use the same value, okay? And keep the firms identical in, so you see they're going to have the same earnings. It's an assumption. This is perpetual cash flows. Perpetual. That's what it does. Then what? Well, there's no interest if there's no debt. So that's zero for the unlevered firm. There's no interest payment. For the levered firm, there's going to be 10% of $400 issue of debt. So that's $40. You can think of these in the millions if you like, but I keep the numbers simple to make the point and not complicate things with the math. All right, so then we have taxes. Taxes, 40% on the earnings would be $80 over here. But taxes of 40% would be not on not on 200, but on the 160. And that gives you 64. Okay, 40% on 160 is 64. So then net income I'll do the math. I'll show you the steps. This is equal to 160 times 0.4. And then this is equal to 200 minus 40 minus 64, right? No questions so far? So what do we have? What are the cash flows? Net income are not cash flows, right? Because here, net income for the unlevered firm is 120. But for the levered firm, if you just look at earnings minus taxes, that's going to be if you leave out the fact that interest payments were made, the cash flows from assets for the levered firm will be higher by 16. What is the 16? The $16 are the tax savings. Remember, just like tax shields, we have now tax savings as a result of the tax deductibility of interest payments. So how did I calculate that? That's going to be, well, it's $16. You can see there's a $16 difference between these two. And that's from, just like we did with the tax shields, it's 40%, the tax rate, times in this case, it's not D, but it's the interest payments. So when you deduct something, an amount, you just take it, the amount. So if it was for depreciation, it was a D. Now it's going to be RB times B, and you multiply it by the tax rate. So the cash flow from assets is increased by $16. So this is really important now, this amount, right? RB times B, well, it's actually, this is the interest payment times TC. So what I'm going to do next is think about that perpetually. So this is going to be the tax savings perpetually, since interest creates a tax deduction, borrowing creates an interest tax shield. Its value is added to the value of the firm. So what we end up with, if in our example it's $16, and that happens forever, That's 160 overall. In symbols, that would be TCB, because this is TC, right? This is the tax rate times the interest payment. And we have to use a perpetuity for that. This is all assumed to happen forever. Remember, this is the theory. These are the assumptions of the model. These cancel and leaves TCB. And so we can amend or augment the original M&M proposition with this. This is the interest tax shield. So now the levered firm is more valuable than the unlevered firm by an amount relative to the amount of debt outstanding. So more debt, more value. So a little bit strange result, right? So this is telling you if you want to increase value, just the firm should be, the most debt it can be. So the value of the firm would be just all a debt firm. So what are the implications of that? Remembering it seems like a bizarre result, but again, we have so many assumptions. We made this happen. And in the next phase, I'm going to mediate or mitigate that assumptions. I'm going to moderate it. I think that's a better word. So I'm going to tune it down because this is a wild assumption. And look at the implications. The implications are that the value of the firm is unbounded. The more debt, the greater the value. And again, shareholders want that, right? They understand that the value of their stock is tied directly to the value of the firm. So they want this to happen. So they will, ironically, or I don't know if it's a contradiction, they will squeeze themselves out because they want all debt. So the firm has an unbounded amount of debt that it could want to have increased value. And this difference is that tax shield, present value of the tax shield on debt, that increases the value of the firm. So I have an example here before we get to proposition 2 that has to do with the WACC. So let me take, let's take 5 minutes and you can stare at this and think about questions you might have for me. So let's take a 5-minute break and think of this over. Has anybody ever seen this stuff before? Have you studied capital structure? You can let me know in the chat. How'd you do? Did you get anywhere with this exercise? Ah, you're so quiet. I mean, in the chat. Obviously, you're quiet. All right. Let's see. So now we're going to talk about the effects on the cost of equity from this rather bizarre conclusion. Okay, so let's see. In this example, we begin with earnings of $100, and that's perpetual. So remember, this happens forever. Taxes are 30%, and the return to investors in the unlevered firm, so no debt, is 12.5%. So let's suppose debt goes from $0 to $100 at 10%. What happens to the equity value? So I've given you some of the results already. So this is 100. 1 minus 0.3 is 0.7. I'll just put 0.7 in there. And then the return is 0.125. So what's the value of the unlevered firm to begin with? So this is perpetual, right? So this is a perpetuity. Notice. This is a perpetuity. It might look a little different, but it's not. It's just a perpetuity. What do you get? It's 560. So this is the value of the firm with no debt, just stockholders holding stock. So that's actually the value of outstanding stock, right? Okay, so let's use the equation that we derived above for the unlevered firm. So it would be, the levered firm. So that would be the one with no debt plus TCB. So what do we get? And we've already done this considering perpetual cash flows. We've come up with this TCB amount. So TC is 0.3 and B is 100. So you end up with 590. So the unlevered firm was 560. The levered firm is 590. So what happened to the equity value? So it went from 560 to 490, okay? Because this was, let me see, this is SU, and then it went to SL. Any questions about my calculations? So taking on $100 of debt, shareholder value dropped to 490. But shareholders like debt. the value of the firm went up. So how does this play out with the, okay, wait, first, let me see. Do you have any questions about my calculations? So these are for the value in perpetuity. This is the present value of future cash flows that we've calculated here. Present value of future cash flows. None so far, okay. Okay. So here we have the proposition 2. We're going to look at the effect on the cost of capital. Remembering our WACC formula here, and we're going to now have this term, right? Because we've allowed taxes, and when we introduced taxes, we also allowed for the tax deductibility of interest payments. And if you rearrange your equation, you will end up with this. So it looks like what we had before. So let's compute the return to shareholders in the levered firm and the average investor. So we have 3 parties to consider. We have to think about the shareholder, bondholder, and the average investor. Remembering, when I talk about average investor, they are investors who are invested in the same proportion, the same propensity in debt as the firm. Average investor in the firm. So for the levered firm, for the unlevered firm, you just have shareholders. So just to make a note, so for shareholders, it would be, this would be RU, okay? These guys here are RS, and this is RB. And from average investors would be WACC. Okay, so I've attached in red their required rate of return. So there's shareholders in the unlevered firm, levered firm. Can you guys see? It looks like my video slowed down. Hold on. Okay, my video was out of step with the chat. Okay. So these are, yes, the return to required rate of return for shareholders if there's no debt. Now we introduce debt, and we call the cost of equity RS for those shareholders in that firm. The cost of debt RB to the bondholders in that firm, and the average investor would be WACC. Okay, so these are the different symbols. And what we see is that return to shareholders in the levered firm is a markup above the return to shareholders if there was no debt. Now, their required rate of return increases with the debt to equity ratio, right? So taking on debt, shareholders still, we had no default risk here, but still, for this to make sense, investors that are shareholders in the levered firm require a higher rate of return. So let's calculate those here, and we'll talk a little bit more about that after. So compute return to shareholders in the levered firm and the average investor, and look at the difference. So what should I do? I'm going to take the information. So all you have from here is RU 12.5. You need this. What else do you need? You need that debt goes to 100. You need a lot of this information. Okay, so remembering this information, and that B is 100. What else do we need? What else do we need? Oh, we need RB. Trying to add these on. So RB was, if you go back, 10%. What else do we need? TC, RU, RB, B, and we need S. And S would be what? That's the S, that should be SL, right? Otherwise we wouldn't be doing this. These all have to be S, this has to be SL. So SL, we calculated at 490. All right, so put it together and tell me what you get. I'm letting you do it. I've done everything so far. It has to be the levered firm because we're talking about debt and equity. Come on. Anyone get it yet? Should I start? So we have 12.5, and then we have the difference of the return to investors and the unlevered minus the debt. So as long as those, right, this has to be a positive. It will be a positive with no debt. The idea of debt is that it's a low risk. This requires a lower rate of return than the. Let me see how I'm going to say that. The return to bondholders, or the risk associated with it, right, is lower. It's a low risk asset relative to equity, right? It's always lower. So this will always be a positive. Let me say that to start off with. So this is a positive. This is why I know, remember, high risk, high return, low risk, low return is pretty much what I'm counting on here. This will always be a positive. So, and then B is 100 and S is 490. And I multiply that by 0.7. What do I get? So I get 12,857. So it's gone up, right? It's gone from 12.5 and it's gone up to 12,857, and it will always go up because this is a positive. It'll always go up the higher the debt to equity ratio. So I made the calculation. Let's calculate the WACC and what happens to WACC. So it's 490 for the levered firm. And then this is going to be equity. So the value of the firm would be 590. And then the return would be and this is 100. Again, 590. And then RB is 10. And 1 minus TC is 7. Is that messy? I should probably make it bigger. So that's what I got. And what do you get? So where WACC is a weighted average between the return on equity and the return on debt, that should be smaller, right? The WACC should be smaller. As R goes up, well, as the debt to equity ratio increases, the required rate of return of stockholders in the levered firm will increase. But what will happen to the WACC? As more debt is issued. You have to remember that the investor in a levered firm, for higher and higher amounts of debt, all the way to the highest, the optimal would be 100% debt. So the shareholder disappears. The investor in the firm becomes a bondholder. So what do you get? No response. So you guys might be like, why is she teaching me this now? The test is next week. I need to teach you this. And you have all these calculations. You have all these notes with you. Just practice with the materials I give you and understand formula. There's not many. And understand the underlying point of what we're doing here. When I'm done, you'll get it. You will get it. It'll make it easier also to understand what you're reading in your text. Did you see me make any mistakes? So I get 11%. I get 0.118642. I'll just use the same I used last time, 5. So what happened? And what is the pattern? What happens is that we have cost of capital on this axis, and I have the debt to equity ratio here. And as there's more debt, and in the extreme case, right, the optimal debt is all debt because the value of the firm increases with debt. So what I've plotted here is the return to bondholders. From the perspective of the firm, it's RB1 minus TC. So every dollar invested by creditors, this is what has to be paid to creditors. This is the cash flow per dollar paid to creditors. This represents the return to investors in the unlevered firm as the baseline we talked about. And this pattern where, by the formula we derived, shows that the return to any shareholders in the firm with leverage will be a line that increases, right? It'll be increasing linearly. But what happens to the average investor in the firm? The average investor in the firm increasingly looks like a bondholder. You're going to have much more weight for bondholders. And so that's why the WACC will, the higher and higher level of debt, the bondholder will be the representative average investor. So that's why WACC approaches the return or the cost of debt, return to debt holders times after tax, let's say. Okay, so that's the pattern. All right, so that's proposition 2, talking about cost of capital. I did an example, so you've seen some calculations. Now what we have to do is make this much more realistic. So the reality is the more debt a firm takes, the more debt it takes, they will be perceived as less likely to be able to pay it, right? So there, at some point, debt cannot be unlimited. Borrowing cannot be unlimited. At some point, there will be risk of default. So we're going to remove that assumption and allow for risk of default and the possibility of financial distress. So we have taxes back, and we've allowed for, so this is like the third case, right? So we've done two cases before. This is like case 3. Beginning with the second case of the value of the levered firm with taxes, although debt provides a tax benefit to the firm looks like it should borrow an infinite amount, the reality is that firm will have to pay interest and principal to bondholders. If the firm defaults, if we remove the assumption that there is no default risk, if the firm defaults on a payment to its bondholders, it will enter a phase of financial distress. Ultimately, if financial distress persists, the firm will declare bankruptcy. So if it cannot satisfy its bondholders with restructuring, making a plan to pay them, maybe selling off assets, changing the way they operate so that they can close operations of the firm so that they can ensure that bondholders are accommodated, right? They can avoid any kind of legal battle, which wastes additional revenues or any profits that have been made. So it'd be wasteful to do so, to fall into a phase of financial distress. But if financial distress persists, the firm will declare bankruptcy. What's bankruptcy? Well, there are costs involved in bankruptcy as well, right? Who's going to get what, and then just the waste. So there, we can talk about financial distress a bit and bankruptcy and what happens to cost the firm and affect ultimately its value. And really this is from the perception of shareholders who are the owners of the firm and their decision to remain as owners of the firm, because they can turn around and sell their stock in anticipation of a collapsing company. So in financial distress before bankruptcy, and with the fear of bankruptcy, there are costs of dealing with litigation or legal administrative costs to deal with how to manage the default on the debt. There are indirect costs as well. So maybe if, let's say, Sears is a good example. Sears has closed many stores all over the United States and Canada, North America. I don't know if there's Sears in Mexico, but in the last decade, Sears has been closing down, and they have quite a lot of business they've had in appliances. So when you buy appliances, this is a big purchase, and people don't want to be buying appliances every year. They want to buy them and they want them to last, right? So often these are bought with warranties, and maybe people will be looking at Sears as though, well, I don't want to buy an appliance because how can they guarantee I will get my warranty service, or I will have any kind of claim for loss, if something happens to my appliances, okay? So they lose sales. And they might also lose partners or suppliers who don't want to deal with them for fear that they won't get paid if Sears buys on credit. So that's going to impair the ability to conduct their business overall. Then we talk about agency costs. So this is about the concern that exists because shareholders, as the owners of the firm, count on managers who aren't necessarily tied to operate in their best interest, right? Managers make a salary. Sometimes a salary is tied to the performance of the firm. You can see that reputation will be affected by the performance of the firm. But meanwhile, depending, maybe managers and executives would make decisions in a collapsing firm. Maybe they'll make decisions that are risky for the sake of trying to keep the firm afloat, or to take a cut or something preferential, a perk for themselves at the expense of shareholders, okay? And so we can refer to these as selfish strategy, making decisions on their own account. So they might have the incentive to take large risks. So we talked about cash flows for potential projects, and we talked about projects that would be risky, but they look like they have a high return in the long run. Maybe they'd be incentivized to take large risks because, well, it's might as well. It's on all or nothing perspective. Might as well just try, right? And in the meantime, the risk falls on stockholders. So this could happen if executives see, that maybe it'll be forgivable that they took those risks because the firm's in the red and in a desperate state. Well, then there's also there could be also an incentive towards underinvestment. Instead of investing in positive NPV projects, those funds, so that if there's profit, if there are any kind of asset sales or any kinds of opportunity for the firm in restructuring to make an investment, instead they choose to not invest in the firm directly, but indirectly, paying themselves bonuses. We've seen that in the past, which is ironic for in the case of financial distress. A firm is doing poorly. Why are they paying themselves bonuses for what? But this can happen. There could also be the milking of property as a third selfish strategy. They could use any dividends, which is promised or committed dividends like in preferred shareholders, and although these are legal measures in desperation, there might be an incentive to do these things, okay? And I think these are tied together, right? So if there's any way of after liquidating assets or having the opportunity to actually invest in a positive NPV project, instead there's a milking of the property, okay? That's used towards themselves in increased perks to owners and management. That's what I described before, so I kind of tied these together. So these are not necessarily legal, and this will have to be borne out in court, increasing the direct costs of financial distress. So what does this look like? What does this do to our model? We need to augment the model further. We have to offset the increased value by this amount. Okay, we have to consider what's the present value of expected costs of financial distress. So if you could quantify the effect of financial distress, you'd put it here, and it would offset any incentive that debt and the tax deductibility of debt creates. Yes, Walmart, Sears, and Kmart, good examples. Big department stores. So for firms with low financial leverage, the probability of default risk is 0. So this would not exist. So we could focus on this part of the equation. But for highly levered firms, the probability of default risk is positive. Okay? In the case where there's a $1 increase in debt, this will increase the tax benefit at the constant rate of TC, but it will also increase costs of financial distress at increasing rates. So what am I saying is that at some point, debt has a negative effect, and that kicks in. Where that kicks in would be, just before that kicks in, it would be the optimal level of debt. All right, so if you believe you can find a pattern, and this is what you can do mathematically, right? You can increase debt as long as tax benefits exceed the present value of the costs of financial distress up to an optimal level B star. So B star would be that optimal level of debt. So visually it looks like this, and we're going to follow this line here. So it's going to increase, but then at some point financial distress kicks in, you see, and it turns away from the straight line and begins to turn down. Now, if you believe that, roughly speaking, you could predict that, you can identify the optimal level of debt. And I think that's the most important thing to say. So follow this line here, or this curve. So when we talk about optimum and optimal, to solve this, does anybody know how I would find this point if I had such an equation? If you had an equation if you had an equation for this, you could use calculus to take the derivative and set it to 0, and you could find the optimal level of debt. And I do like to do that in this class, but I'll give you some examples. I didn't give you any examples. This won't be on the test, but I think it's very interesting that you see, it's very important that you see that's possible, all right? And that you appreciate the skills you learned in MECU to be able to do this. What happens to the cost of capital? So we have to adjust now the WACC because we have the return to the average investor being partially the shareholder, partially the bondholder, but then this cost, this premium that has to be paid to financial distress for taking on additional debt. So now what happens is the weighted average cost of capital turns up. But why is it turning up? Well, essentially, it's partly because of the cost of debt that kicks in after this point, the optimal debt. Now notice I've written debt to equity ratio. That's on this chart here, but it could just as equally be, this is the same idea as what we had in the chart before. See, I have debt here, but then I have it as debt to equity for the purposes of this formula here. So this turns up because of this kicking in. So I'll say this is 0 until you're here, right? So this is 0 till here. And then the WACC, the return to investors in the average investor in the firm with debt will increase. So that's partly from this premium, but also the fact at some point, even debt holders, because of the risk of default that we introduce now, they're also going to require a higher rate of return to actually purchase that debt, okay? It's going to be very risky after some point. You see that goes up. All right, so what I've given you for practice are a number of exercises. There's nothing here. A number of exercises that illustrate these patterns, and I'm going to send you, actually let's do one. We have an hour. I'm going to send you something right now. Give me a minute and we'll do some calculus together. Give me 5 minutes and I'll get back. Ask me any questions that you have. All right, I'm back. I'm going to send you this, but right now I'll just keep it on here so we can work together, okay? I'll send you this and I'll send you the calculus review. It's good for you. You can have it. And remember me by it. It's a good review of everything. All right, so here we go. So this is what we're going to work on, and then we're going to go. So what your focus should be for the test is, remember it's going to be a connect test, so it's going to be those type of questions, but the material that I've given you will be the best for you to practice with. I did put questions in Connect for you guys to review, so I recommend you do those. Don't worry about your grade, just work with the Connect questions, because if you've answered all 3 of the assignments already, you don't have to do the last one, but I still recommend doing the last one for review. Don't worry too much about your grade if you've done them already, but if you need the last one, there you go. You have your 3rd assignment if you didn't do one of the others. Okay, now, assuming the model with corporate taxes and financial distress, so we're in case 3, and that CAPM is true. Protect Corporations Incorporated is a corporation financed with debt and equity. $80 million of its assets are financed by debt, paying an effective annual return of 7%, and the remainder with equity. PCI's earnings are subject to corporate taxes at a rate of 40%. A financial analyst has estimated that if PCI were all equity, it would have a market value of $500 million, and that the return on investment in PCI's equity would be 18%. So we have a lot of work done for us already. The financial analyst believes that there are costs of financial distress associated with debt, and the person estimates the present value of these costs to be either one of the following. So what you're supposed to do is find the optimal level of debt. So I said I'll send you guys these questions and answers after we're done. Let me get rid of this. Sorry, let's get rid of this. And so the first question is, calculate the market value of TCI. Okay, let me copy that question and all of this stuff here. Okay. So both B and PV are representing in millions of dollars in this function. So calculate the market value of TCI under its leveraged capital structure in either case. So we begin with an expression that the value of the levered firm is the value of the unlevered firm plus the tax savings from interest payments minus the present value of costs of financial distress. So I'm just going to say, you can say it the long way, or financial distress. I'll put C, cost of financial distress. And so, what do we have? We have information. I should join these. So we have information that the unlevered firm was estimated at a value of 500 million. And then I can put an M there to avoid confusion. And then the tax rate is 0.4, And the debt that we're talking about is 80 million. And now we have, let's use the first equation. Where debt is 80 million and it's 30 on the bottom. Now, we want to find the optimal level of debt in that case. But first we're going to calculate the market value, okay? So let's calculate the market value currently. And so put all that together and tell me what you get. Let's see if somebody is following. Even if you didn't understand, you can make that calculation, can't you? So as long as all of my values enter are in millions, I can avoid putting 6 zeros behind all my numbers. What do you get? You should get 517 million, 517.61. Questions? So that's the current market value. So now let's find the optimal market value. So you take the equation, oh, I have to take the equation with my values inside. I'm going to take the equation 500, because that doesn't change, right? And then TCB will change because I'm changing debt, so that's a B. And then E, and this will be B over 30. So that's the equation that I need to optimize. That's the value of the firm. So I take the first derivative, and this is just a constant, so this will be 0. This one is a function of B, so I should write that to remind you this is a function of B. Or let me write it like this. That VL is a function of B, so you can see that. And I'll do the same down here. But what I want to do is take the derivative. So then this would be, what is the derivative of this? So we need to remember e to the x. If fx equals e to the x, then f prime x is equal to e to the x. If fx is equal to e to the ax, then f prime x is equal to the derivative of ax times itself. Oh, that's not right. Ax. You guys are with me? This should be just entertainment right now, because I'm not going to test you on this, but you should practice it if you're really serious about finance, or you have any interest in finance. It's worth looking at this. It's very interesting. Okay, so that makes, in this case, the derivative of this is 1 over 30. So it's 1 over 30 e b 30. And then what you do with the first derivative, because this is, well, we're presuming it's going this way. It's going to be like that. We want to know where's the spot that the derivative is flat, because derivatives are just slopes along this curve. Slopes of that point, slope at that point, slope at that point. We want the slope where this, we want the point where the slope is 0, and that would be the optimum value. So we are going to set the first derivative to 0 because the derivative is the slope. It's a function of slopes, but we're just going to use one. So I'm going to set it to 0. And you're going to solve for b. So what should be, what is the optimal b? No, got all separated again. And then this becomes This is 12 equals EB 30. So then to find out what B is, you need to take the logarithm. B is equal to 30 ln 12. Notice I didn't have to put any m's in there. There were no m's millions, but the result will be in millions. That's how we interpret it. So 12 ln times 30 is 74 billion. $547,199.49 to be precise. I guess I can eliminate the decimals for this one. So almost $75 billion is the optimal level of debt. And we, in this example, we're operating with 80, right? So we went over. So find, now that you have the optimal level, I'm going to put a star on it, asterisk. Now find the optimal value with the optimal level of debt. So you're going to plug that back in to this equation and tell me the value. I'll wait. So if you didn't understand anything, all I want you to do is plug this value in to this equation and tell me what you get. The original equation. So the only thing that may have disturbed you was my derivative, but otherwise, this is the equation that we're going to use, and just plugging in the value of debt. And if it's easier, you can do this in Excel. So you have the equations laid out for you. Anyone? No one? Give me a number. So when you plug that in, you get the optimal level, which would be higher than the one we already got, right? Because the other one up here was, it went beyond the maximum. So the one that we get now will be a little higher because it's the optimal level. Right? So if we think of it as a curve, then B star would be here, but we went over B star because we put in 80 million and B star was 75 million. Yeah. Sorry. Did we say billion? Million. Did I say billion? It's million. Okay, so million. So 517 is a little below. So what's ours? Nobody? Nobody? Somebody? Tanya? Juan? Ariana? I get 518. Just a little bit more. Okay, now how do we know that this is a maximum? How do we know that it goes like this and not like this? Remember, this has to be a frowning face. The second derivative has to be a negative. And if it's a smiley face, the second derivative, in the second derivative, then we'll know it's a minimum. So this is max, and this is min of second derivative. So we have to take the second derivative. We have done the first, now we're going to do the second. Second derivative would be just the final term. And you'll see that it's going to be 30 squared, and then EB over 30, and this will always be 0. For all B greater. For any level of debt, the second derivative will be a negative. So yes, this is a maximum. So we found the best level of debt. Given the assumptions, given we believe this is the model for financial distress, including financial distress. And then some of the other assumptions, perpetual cash flows, and I think that was the main one, because we allowed for default risk and we allowed for taxes, right? All right, questions? I don't know, isn't that neat? I hope you followed. So this is what you can do with calculus, all right? This is an example of what you can, how you can use it to optimize. Much of business is optimization. So keep your eyes peeled for where you can take advantage. Other financial economists, statistics experts in finance, they do take advantage using their skills to apply them, right, to finding strategic decision, to helping them make strategic decisions. Okay, so there's another one there. Should I do it or should I look at the other stuff? So I'll send you this. I want you to understand it. You should be able to understand what I've done here. Maybe you won't make a perfect calculation, but you should have been able to follow me. Do you want me to do the other one? Or do you want me to look at the other things I gave you? The other things I gave you are just exercises with solutions, discussing the propositions, the three different propositions. Well, there are two propositions, but I mean 3 different cases. Because the proposition 1 is regarding the value of the firm, and proposition 2 is regarding the cost of capital. But there are 3 cases. 1 with all those assumptions that make it so that the value of the levered and unlevered are the same. And then I relax the assumption of taxes not existing, so I put taxes back. And then finally, in the 3rd case, I allow for default risk as well. Would you like me to do this one? Are you guys good? Because I can send you these solutions, like I said. You can look at these. And I'll send it with a review for calculus so you guys can have that as a memento you can remember me by. Okay, no questions? You're going to be in touch with me over this week, asking me any questions that you have. Letting me know if you need any review or clarification. Otherwise, I'm going to say goodbye for now. Hopefully, we see each other in the new year for those who have a year remaining or a semester remaining. And for the others, congratulations. You are on your way to graduating, and I wish you the best. Keep in touch. Let me know how you're doing in the future. I have personal emails for you, but if you need anything, you want reference letter, you want some insight of mine, you can contact me because you have my email address too, okay? So with that, I'm going to say thank you. And let's see, you have some questions here. I'm just reading Juan's comment. Thank you for the compliment. Diego, the questions will be from Connect, right? But they're going to be easy, Diego. They're not going to be so hard. It's just that I want it to be comprehensive. So make sure you know what's going on. And I think my exercises help you understand what's going on more comprehensively. But do what you must to understand or review the material. So, just review solutions, and where you get stuck, just let me know and I can explain problems that you don't understand. Remember, you get to look at all the problems, and you're going to have 3 hours, and you'll have enough time to finish the test. Yes, you can, Ariana, you can use everything. You just can't use the help of a human being, okay? In the 3 hours, you're going to have to turn the video on. You have to make sure it's going to be with the camera, okay? The exam is with the camera. Maybe I should send an email about that. The exam is going to be conducted with the camera. So make sure you set up your room. And what I'm going to ask you to do at the beginning is to show me your ID in the first couple of minutes. Hold up your ID to the camera. Just hold it up for a minute for me to be able to see it, or almost a minute. Make sure it's not blurry. Yeah, exactly. A human being, like real-time communication with a human being. So you shouldn't be texting anyone. You shouldn't be talking with a tutor or a friend or anyone during the exam. It should be all by yourself with your materials. So you can prepare all your materials, any kind of summary sheets, any answers that you don't feel comfortable with, but if you have them by you, they make you feel better. Keep those close by. Okay. Julian's asking, if we graph the formula, can we get the max and min numbers? It's going to be hard. I mean, if you're talking about this graph, yeah, you mean if you graph it on your calculator or something? Yeah, if you could find it. But this is easier. I don't know. Do you think that's easier to graph it? I'm trying to think. I don't know. I don't know how you would graph it. If you have an ability to graph it and find it, then that's great. Calculus isn't that hard. I'll give you the formulas. But like I said, I'm not going to ask you this on the test. This is not going to be on the test. This is just for you to understand the skill and integrating, synthesizing what you've learned in your studies so far, that you have the skill to find this optimum is incredible. Thank you, Diego. Thank you, Danella. Thanks for attending and providing feedback and helping me to make this the class that you need it to be. Okay? And I wish you the best. Oh, my dear. Me and my iPad. I'm still learning. Imagine how good I'll be in a few years. Thank you, Ariana. Bye, Julian. I'm glad, Tanya. I'm glad that I could teach someone who knows a lot more. Thank you, August. We're almost done. One more week. It's the countdown. Paula, I'm not going to give you the clave for the test because I need those for my summer class. Is that terrible of me? But what I will do is I'm going to send you the graded tests so you'll have them, and then you can ask me. You'll have the graded test. I'll send you the graded test. Okay? You might not have it in time to study, but you have so many other materials. I'm sorry that, like I said at the beginning, I'm just so busy, and we're hiring a new professor, and that's what I'm going to work on this weekend. But after that, I'll be grading your materials, okay? And I will send them as soon as possible, and then you can ask me. I won't submit the grades till the end, till the last date, so you guys can get back to me if you have questions about the grading of the tests, which is fair. And I apologize that they're not back to you sooner. It's just an unreal amount of work that I've had to do this semester with committees and, unfortunately. But we are getting a new professor. It's exciting. Well, not necessarily a professor is going to become a faculty member, so that's going to be good. Might not be you. You might know the professor. You might have had him before. All right, so I'm going to sign off. Have a great weekend and study week. Okay, Juan, I will do my best. You're very flattering. I mean, I appreciate the compliments. I'm here mostly for the students. You guys keep me here because the other things that I do aren't so, I mean, at the university, the committee stuff, I don't feel rewarded really doing the committee stuff. I get really beat up because I have different opinions than people, but I really appreciate, and it's the most rewarding, the work I do with the students, and that includes the research I do with the students. But my classes, I really adore my Rio Piedras students. So it's easy for me to be dedicated and patient. Thank you, Yamar. Thank you, Paula. Keep in touch, okay? Write me if you have any questions, and I'll be working on the grading. I have to find a new Netflix series to watch while I grade, and that inspires me. I have to find a new one. You guys can leave your recommendations in the chat. I actually subscribed to Hulu because I wanted to watch Handmaid's Tale, but they're doing it slowly. They're releasing one a week. It's not what I'm used to. I like to have the series right there for me to watch the whole thing. So we'll be in touch. Bye.